president of Strategic Economic Decisions. I run a think tank that is somewhat unusual in that we are known for addressing big problems and going deeply in trying to resolve them. No sound bites today. None. The topic that I'd like to talk about, and I'm constantly being asked about this, is the new Fed policy of quantitative easing. In particular, number one, does it lead to lots of inflation once we print all this money? And number two, it's supposed to help get things going on Main Street. Does it actually do so? And if so, how does it improve the economy on Main Street? Which Fed Chairman Bernanke claims it will do. Let me start off by pointing out there's an awful lot of confusion about the topics I'm about to talk about. It's not only that people are confused, they ought to be confused. Just as if I hear an oncologist talk about cancer therapy, I don't have a clue what they're talking about. I know nothing about it. QE is technical, but it can be explained quite simply, which is my goal today, which I'm known to be able to do. This is sort of a thing I like. But the difference with oncology and QE is major importance in affecting the future of the country. If it leads to rampant inflation, God knows what you end up with. If it doesn't even work on Main Street, why did we do it? This is a pretty important topic. So let me start at the beginning. Before we do anything else, I have to tell you about a fundamental result in macroeconomic theory. It was uncovered by a man named Jan Tinbergen in Holland in the early 1950s. It's a very important result, and he would end up receiving the first Nobel Prize ever given out in the history of economics. Tinbergen was interested in what Keynes was interested in. How do we use government to fix Main Street? Keynes told us you have deficits in bad times, surpluses in good times, and so forth and so on. A man named Irving Fisher at Yale had introduced monetary theory, money velocity, money inflation, money quantity, money demanded, all of this stuff. And Keynes put everything together in his famous book, The General Theory, in 1936. What Keynes did was to set forth a lot of concepts the way I am right now. What he didn't do is tell the philosopher king what to do every quarter in fixing the fiscal and the monetary knobs. Repeat, the Fed has to change interest rates and can, and government has to raise or lower the deficit and can. The mathematics for figuring out what's the best way to set the knobs every quarter wasn't even worked out until the late 1940s, both in Russia and at the Rand Corporation in California. Tinbergen used this new theory of optimal control in 1953, and finally the philosopher king now had the tools whereby the philosopher king could determine what's the right setting of the fiscal knob, what's the right setting of the monetary knob, and we would be on our way to a speedy recovery. Now, one of the things Tinbergen discovered was the following theorem. If government has, say, end goals to achieve, typically two goals, full employment and price stability, think apple pie and motherhood, then it needs at least two independent knobs on the dashboard to control the system. If you don't have at least as many independent control variables as you have goals, your rocket won't reach the moon, so to speak, and the system is called non-controllable. Now, hopefully you have 5 or 6 knobs to achieve your 2 goals. That means you get to the moon and also the landing is nice and smooth and soft, okay? What I'm going to do is to interpret QE in the following manner. The Tinbergen theorem is basically saying if something happens to cause there to be more goals than before, you're going to need more independent knobs on the dashboard, or you won't achieve recovery. you won't achieve your goals. So simple. Now, traditionally, the main job of the Fed has been to keep track of inflation and control it, and also to affect growth on Main Street, but mainly most central banks are concerned with inflation. The tool that they used for that objective was raising and lowering the Fed funds rate. How does that work? How does it, in fact, deal with inflation? When the Fed raises the Fed funds rate, which you read about in the paper all the time, it does so by selling a lot of securities that it holds onto the open market. More supply pushes the prices of securities down in the open market. But as you know, in the case of bonds, when you push the price of bonds down, interest rates go up. So that's sort of how the Fed can raise interest rates. It's how it does raise interest rates. But the way that that happened, which is complicated to explain, is such that you have withdrawn the degree to which banks can make loans. You've tightened up on credit. Does everyone see this? Raising the Fed funds rates means it's tougher to go get loans. It slows down the economy a little bit. In addition to the fact that raising the Fed funds rates reduces the amount of bank reserves which are needed to make loans, the mere fact that interest rates are higher, and typically when the Fed funds rate goes up, the 10 and 30-year note yields also go up. The result of this is Main Street slows down. Higher interest rates slow down growth on Main Street. You can't now afford that new house mortgage. I'm going to cut back on this purchase. The result of all this is that the pressures on prices abate. The higher Fed funds rate slows things down, creates an extra supply of widgets relative to demand, pressure is taken off prices, and the price level goes down. So the Fed can impact inflation by using the Fed funds rate. Here's the problem. In 2007-2008, something absolutely dramatic happened. Of course, the housing collapse, Lehman Brothers and all of this. Now suddenly, like the actress Madonna, the Fed had to reinvent itself. The Fed was faced this time with the goal not of affecting haircut prices on Main Street, but this time with preventing the entire financial system from vertiginous collapse. It had to step into the ring as a lender of last resort, especially in the housing market. It had no choice but to do, quote, quantitative easing in the form of buying in lots of mortgage-backed securities. This was the beginning of QE. QE means that the Fed, for reasons having nothing to do with changing the Fed funds rate, goes out and buys corporate 10-year bonds, goes out and buys 30-year treasuries, goes out and buys mortgage backs. In the case of mortgage backs, it had to buy them to support the market as lender of last resort because nobody else would. So, basically, what we're saying is, with the new goal of not only controlling haircut inflation on Main Street, but now preventing bankruptcy of the system, the Fed had to have a new dial on the dashboard via the Tinbergen result, and the dial was QE. Now, QE basically means, in the abstract, that the Federal Reserve Board of Governors in Washington instructs the New York Fed, which manages open market operations, to tell its primary dealers like Citicorp and UBS, go buy in $1 trillion of bonds. The result is, as you've read in the papers, the Fed now has a balance sheet because of all these new assets that it's holding, all these mortgage backs and treasuries. There was originally around $880 billion of assets that it held. Now it's up to 1.8 trillion. It's going to over 2 trillion. Because now under QE3, Greenspan said that every quarter they're going to be buying in and continue to buy in securities. Not that many, but enough. It's the way it works. So let me make this crystal clear. When people understand that the Fed is now buying in all these assets, they think that the Fed prints money to pay for this. Well, oh my God, when you start printing money at that rate, as did Weimar Germany and Zimbabwe, you're just creating an awful lot of new dollars, chasing a fixed number of widgets and Starbucks coffee cups, and the price does what? The price goes way up because there's a lot more money chasing the same number of goods. This is known as a monetary inflation. This is an incorrect understanding. Let me put it more formally. When the Fed decides to have its primary dealers buy in $1 trillion of these assets that are now assets on the balance sheet of the Fed, as you know, you have to have a corresponding increase in the liabilities in the balance sheet of the Fed. Now, there are two kinds of liabilities. In English, two ways the Fed can pay for these new assets. It can print currency. The first liability is called total currency in circulation. I think it's about 801 billion when I last looked. The second thing it can do is print bank reserve notes. Actually, it doesn't print them. Here's how it works. When UBS buys in $1 trillion of assets for the New York Fed, the way it's paid is its reserve account with the New York Fed is credited by the $1 trillion. We never print money in America. We don't use the Zimbabwe, Weimar Germany, turn on the printing press, and notice their $100 Deutschmark note went to a $10 million note. That's hyperinflation. Notice we still have $100 bills. We don't need any more than that. We don't have money inflation. We never print money. What we do is the bank reserve route. So in buying in this will be soon 2 trillion of assets, the banks now have 2 trillion more reserves, what we call free reserves, than they used to. Citicorp is happy because for every dollar, as you remember from Ec 101, for every dollar of free reserves the bank has, it can make a $10 of loans. That's the notion of a 10% reserve requirement. Repeat, you have to keep on reserve for every $10 in new loans you make, a new dollar of reserves. This is a 10-to-1 reserve requirement. So Citicorp, with a lot more reserves than UBS, are very happy because they can now go out and make a spread. My God, if we're ending up with 2 trillion of new bank reserves and we're nearly there, oh my goodness, that's a $20 trillion of new loans. Citicorp makes spreads of 2% or whatever on all those loans. Hallelujah, this is terrific. That's the problem. When Citicorp makes loans, it puts a check in your bank account, and by a point that Keynes used to make, when people borrow from a bank to get an extra $1 million, they don't put that under a mattress because they're paying for it, they go spend it. So if 2 trillion of new reserves could turn into 20 trillion of loans in your bank account and mine, and we go spend it, you're right back to masses of new money chasing the same number of widgets, and the price of Starbucks coffee goes to $2,000 from $2. That's the way in which what we're doing can lead to huge inflation. This does not need to be the case. First of all, notice in Japan, where you've had something similar, Mrs. Nakagama never asked for a loan. If nobody goes to Citicorp, knocks on the door and says, I want a loan, Citicorp can't put any money in her account. There's no growth in the money supply. There's no inflation at all, nor has there been in Japan, nor in America in 3 years. The Brocks, the Joneses, and the Smiths are all retrenching. We binged borrowed for 35 years. We're facing retirements that are bleak. We're not going to be borrowing, and IBM has masses of cash. It doesn't have to do much to invest, and it's not borrowing. So banks have an unprecedented holding of what we call idle reserves collecting dust. There's no inflation. But Woody, the sun's going to come out. Tom, Dick, and Harry are then going to want to borrow. Correct. The sun's going to come out. What does the Fed do to control the inflation when Citicorp starts making all these loans, which is now free to make? Typically, the answer is the Fed will unwind its position, reverse the balance sheet, sell those assets back to the market, and the process of doing that will extinguish all those excess bank reserves, and now Citicorp cannot go make all those loans that leads to the inflation. The problem here is, suppose that the only assets that the Fed had bought in, for example, were mortgage backs. And when the sun came out and it was time to unwind the balance sheet, nobody wanted to buy mortgage backs. The Fed's most important asset, incidentally, is credibility. The Fed's very cautious. They couldn't think of having an auction where no one bought the stuff. It just doesn't happen. They lose credibility, and that is everything. So now we have a dilemma. What happens when the sun comes out? What happens if the Fed can't unwind its balance sheet in an orderly manner? The answer to the question was the Remuni rate, a completely new concept and a new variable. It was enacted as a law in 2008. It is known as the Reserve Remuneration Rate Act. By this, the Fed can now pay banks for the reserves they hold. Never before was this allowed. Right now, they are paying banks 1/4 of 1%. That's 25 basis points for every dollar of free reserves that the bank holds. I think it's free reserves. It could be total reserves. I actually don't know that. So, when the sun comes out, now we can do something very different. All the Fed has to do is announce at noon, we're raising the remuneration rate for reserves to 5%. What will Citicorp do? Fire half of its bankers. Those are the bankers out shaking every bush to lend to bad credits like me so they can make a 2 or 3% spread. My gosh, now they can have a 5-martini lunch in New York, fewer bankers to pay for, and get 5% risk-free for sitting in those dusty reserves that are doing nothing? That's correct. So what happens is they can now use the amount they pay Citicorp effectively to bribe it not to make inflationary loans. It can regulate the rate at which the reserves turn into loans and money in your bank account and mine. This is quite an important point. It also means the Fed actually never does have to unwind its balance sheet. It can hold those useless mortgage-backed securities for 8 years, and then when they have value, sell them. The Fed is very clever at not losing money. It can wait like a black widow spider. Or maybe it doesn't, they just expire. The point is, the Fed can hold these securities until the cows come in. This is very new stuff. So I've answered one question. I haven't said that QE won't lead to inflation. I've said that if government does its part, and if the Fed does its part, there need be no inflation from QE, and so far there never has been, but that could change. The second question is, QE, does it work on Main Street? Does it revive the economy? The 3 or 4 ways whereby QE is supposed to help Main Street grow faster. Number one, once again, when the Fed goes out and buys in a lot of these bonds and things, by adding demand to that market, it pushes the price of the bonds up, which is to say the interest rates, the yields go down because they move inversely. Lower interest rates mean that, well, I can afford a mortgage and you can afford to put more in your credit card and we go out and spend more. Second, the lower interest rates that result create a wealth effect. This is quite indirect. The lower interest rates means that the value of your bonds and stocks and houses usually go up. So Woody Brock's net worth is higher. Good. That's called a wealth effect. I'll go spend more. The higher your net worth, the more you're apt to spend. Third, the act of QE tends to push down the value of the dollar. Well, I don't mind that. That means my hotel's going to be busier and the factory will be busier. I don't mind. It's good for Main Street if the dollar goes down over here. We export more. So, these are some of the ways in which QE on an ongoing basis, which is what QE3 is all about, that the Fed is now going to continue to do this, is a way to continue to make Main Street a little bit better. Lots of people have problems with this. They say, wait a minute. Dick Fisher, Richard Fisher, the chairman of the Dallas Fed, very critical of QE, says, for example, we've got a 1.5+ trillion of free bank reserves. Do we need any more? He's making a bit of a mistake. He's confusing what we call a stock versus a flow in economics. We have 1.5 trillion from past behavior. What Bernanke is saying is we now need a continuous future purchase so that we in the future keep interest rates down by always being a source of demand for these securities. And in that case, it's Bernanke who's right and Fisher who's wrong. Next, Fisher can say, okay, let's question whether or not by being an ongoing buyer of these bonds, it really does push interest rates down and help Main Street. He concedes that in the case of mortgage securities, it really is good for the mortgage market if the Fed is willing to buy this stuff in. But he's very dubious about Main Street in general. His point, coming from a survey at Duke University and from private sources, basically says that business people today don't want to borrow, regardless of the interest rate, until the fiscal cliff is resolved, the European crisis is resolved. The policy uncertainty is befogging the future to such an extent that many households and businesses are staying on the sidelines, like you and me. I mean, what do you think of this crazy stuff that's going on? I'm not going to do any big moves right now. I hope I've been able in this short discussion of a difficult topic to help resolve some of the myths and half-truths surrounding it. I've addressed the question of need QE be inflationary? The answer is no, it need not be if government does the right things, but it could be. And secondly, I've addressed the question, how does QE affect growth on Main Street? I've conceded that yes, Bernanke is right. You would expect this extra purchase of bonds to lower rates in such a way that presumably Main Street picks up a little bit. But this is debatable, especially when what matters to people today is not the level of interest rates at all compared to, will we have a fiscal collapse? Will we have a fiscal cliff? Will Europe collapse? So many other much bigger issues might override the impact of QE. We end up worse off. So QE is one small way to help Main Street. Thank you very much.